All right, good afternoon. Welcome to the webinar. This is Awais, and the topic of today's webinar is really going to be how to best use the analysis and content provided on the EminiPlayer.net site. Now, before we jump into it, if you want to just give this risk disclosure a quick read, understand that futures are obviously a risky instrument to trade because they are leveraged, but with the proper risk controls, they are actually one of the best markets to be trading and can result in very good returns if you know what you're doing. So with that out of the way, we're going to go ahead and move on to the webinar itself. So like I said, the intent of the webinar is to go over how to best make use of the analysis provided on the EminiPlayer website. And my goal is to explain things in as simple of a way as I can. So the goal is to simplify and not really get into the complexities of what goes into creating the support resistance zones and kind of the nuts and bolts of it, because I think that would require much more than a single webinar. So the way that the webinar is structured, I'm going to go over a high-level overview of my methodology, and again, the intent is to simplify it. After we've done that, I'll dive into the EminiPlayer website, because we have traders on the webinar who are perhaps newer members. They might even be new to trading, so I think it would be very good to cover the website itself. What does it consist of? How to make the best use of it? How it can really benefit your trading? So we'll go into each of these components here. And then we'll jump into trade execution and tools of the trade, or what to watch during the day to help you make good trading decisions. Now, before we jump into the method, one thing I'll say is that trading is a game of skill, right? So there has to be a skill development component to your trading. It's not about being overly mechanical, and it's something that does require building some real skill. And in that aspect, it's very similar to poker. Now, when it comes to skill development, I think what throws traders off and what makes this very challenging is that the skill does not show up on a trade-by-trade basis, right? So what I mean by that is that you could be the most skilled trader in the world, but on this given trade that you're putting on right now, that is still going to have an element of chance, right? Because it's a game of probabilities, and the skill only shows up in the long run. So that means you need a large enough sample size of trades to actually determine how skilled of a trader you are. On any single trade, the professional trader and the total amateur might have actually very similar odds of the trade working out. So on a trade-by-trade basis, there is going to be an element of chance, and the probabilities are not really going to play in your favor until you have a large enough sample size. And I think one of the mistakes that many traders make is that they start to judge themselves on a very small time horizon, where if they have one or two losses in a row, they think that's a bad thing. But that could be very normal for the methodology that you're trading. Having 1, 2, 3 losing trades in a row might not be a big deal, and it may not reflect at all as to how skilled of a trader you are, right? So I think it's important to understand that trading is a game of skill. It requires skill development. It requires that commitment and that daily focus on trying to get better, but it's not going to show up on your next trade. You're going to have to give it some time. And then once you've given it enough time, once you have enough of a sample size, that's where over a slightly larger time horizon, perhaps over a month, over a quarter, you'll start to see that skill playing out. So in the long run, it's a game of skill. But in the short run, it's more random and probabilistic, right? So that being said, let's talk a bit about my method and how I trade. And again, I'm going to try to simplify it and boil it down really to the essence. So the way that I look at the market is through the lens of market participants, right? So number one is that when I'm looking at a chart, I'm not just thinking of it as lines on a chart. I'm not just looking at swing highs, swing lows, I am trying to understand how the market participants behind the chart may be positioned. I'm trying to understand the psychology behind the chart, right? So if I quickly just bring up a larger time frame chart here, so we're looking at a daily chart. So when we look at this, clearly anyone can identify swing lows, swing highs, but then in between the swing lows and swing highs, there are trading ranges. But then within these trading ranges, we have to understand that essentially what's taking place is that there are market participants who are bullish and there are participants who are bearish. That's always going to be the case. And they are essentially placing their bets based on whatever their view might be, right? So they are exercising their view, they're showing their view by actually placing trades. And they're either going long within that trading range or they're going short within that trading range. And while the market is range bound, neither side is technically very dominant or in control. But then once the market breaks outside of a trading range, what does that do? Right? Again, we don't have to think of it just purely in terms of a chart. Think of it in terms of market participants. Right? How is the market going to be affected when the market has been very sideways and then one side completely takes over? Well, when that happens, the other side is now put in a losing position, right? So think about how you would feel if you were short from a trading range or if you were long from a trading range and then you got either a breakout or breakdown. So start to look at the market through this lens of market participants, right? Not purely just as a mechanical kind of swing high, swing low type of view. Now, in terms of the methodology, it really revolves around understanding the market environment, right? So when it comes to the methodology, I would say everything is contextual. So the market context plays a big role, and awareness of the market environment that you're trading in is paramount. Now, when it comes to market environments, we can simplify yet again. Now, the markets are either going to be directional, where one side is dominant and the market is essentially trending or moving in a very directional way in one side, or the market is going to be balanced or range bound or sideways, right? So you can either have a sideways market where it's just kind of going back and forth between a trading range, or you can have a directional market. And the same thing can be applied to the day time frame, right? You can have a directional day or you can have a two-sided or balanced day. Now, majority of days are going to be relatively range bound. And that means that as day traders, which is our time frame, right? It's very important to understand the time frame that you're trading on so that the trading decisions you make take that time frame into account. So on the day time frame, if we're dealing with a range-bound market, and especially a range-bound day, as day traders, we can find opportunities on both the long side and the short side. And to very simply state the methodology, when the market's range-bound, we are looking to fade support resistance zones, right? Anytime the market gets a bit overextended into a support zone, we will look for a long opportunity. Anytime the market gets overextended into a resistance zone, we will look for a short opportunity. So at a very basic level, in a very simple way, the methodology is to look to fade zones on balanced sessions, and then when we identify the market to be in more of a trending or directional type of environment, that's when we stop fading zones and we start to look for ways to get on board that directional move. So if I had to simplify it to the core, that's what it would be. On balancing days, which are the majority of days, we're looking to fade support resistance zones, and every other day, which is the minority, right? Trend days happen only maybe 5% or so of the time. On that minority of days, we are avoiding zone fades and we are going with the trend and we are going with that direction. And that is really the method in a nutshell. If you had to kind of simplify it to just a couple of lines, that's what it would be. When the market's in a balancing environment, look to fade zones. When it's in a trending environment or a directional environment, look to get on board and avoid fading zones until the market gets overextended on a larger time frame into an even more important and stronger area of support or resistance. So even directional environments don't remain directional forever, right? So the market may be directional, but it doesn't mean it's going to remain directional indefinitely. Eventually, it hits a larger time frame area of support or resistance, and that is where there can be a turning point, or at least a temporary pause in the market. So in a nutshell, that's what the methodology comes to. Now, with that being said, a very core part of the method is the idea of reward to risk. Anytime we're taking a trade, we are thinking about the reward to risk on that trade. If we are risking 3 points, then we want to get at least 2 times our risk. And what that means is that when we are thinking about the target on that trade, we should easily be able to get 2 times our risk at the very minimum. So that is the minimum criteria before you take any trade, is you should be able to get 2 to 1 reward to risk. And if that is not available, or if the target seems out of reach, then it's a trade that you should skip. And to learn more about that, there's already a webinar I did on money and risk management. So if you haven't seen that, the recording of that webinar is available on the website, and I highly recommend you watch that because it goes over position sizing and reward to risk in much more detail, and it is a core part of the methodology. Without that, fading the zones or even nailing trend days, it's not going to result in the type of performance and profits that I think everyone is looking for. So that's a very high level overview of the methodology. At this point, we will jump into the EminiPlayer website. And as I go through the EminiPlayer site, I'll explain kind of each element in a little bit of detail and how to use it, right? How to get the best use out of it. So here is the website. Every morning I post a trade plan, and you can access it by going under recent trade plans and posts, and the latest link will show up right over here. So here's the trade plan, for example, for April 23rd, 2018. We go over there into the plan, and then the plan has 3 elements to it. First is the trade plan video. Now, like I mentioned earlier, the method really revolves around understanding the environment that you're trading in, because there are particular trade setups or trade ideas that work well in one environment but fail spectacularly in another environment, right? So for example, zone fades work really well in a balancing type environment or a range bound environment, but they don't work when the market goes directional. They don't work on trend days. So in order to get the best results, it's very important to understand what kind of environment we are in. And that's really what the trade plan video is all about. In the trade plan video, I'm talking about the environment of the day. I'm talking about the market context of the day and how we're going to tackle the upcoming trading session. So if you're using the zones without watching the video, then you're really missing out on that context, and you're not going to get the best results by trading the zones in a complete vacuum. Again, the market context is very important. It's paramount. So without understanding the plan for the day, the strategy for the day, it's going to be difficult to get really good results. Now, once you've gone through the video, you can see down here we also have the key zones chart. So if you click on that, that will expand it, make it full screen, and this is where you can actually go see the zones. And when it comes to support resistance zones, anytime something is titled or labeled pre-market support or pre-market resistance, that is going to be the aggressive area of support or resistance, which means that we're going to be more careful there, right? That means that we're not just going to typically just blindly get in at pre-market support or pre-market resistance. Now, when it comes to support resistance zones, understand that there are 3 roles that a zone can play, right? You can either use a zone as an entry point. That's one purpose that it can be. You can use it as a target or an exit, or a zone can help us determine bias. So these are the 3 main benefits or the roles of any given zone. And if it doesn't meet one of these, then you really won't see it on my chart. And if you guys are doing your own support resistance work, then that's something that can be beneficial to you too. Is think about what is the purpose of having a particular area of support or resistance. Are you going to use it for an entry? Are you going to use it for an exit or a target? Or does it help you figure out which side is in control? Does it help you with your bias? If it doesn't meet one of these three criteria, then it doesn't have to be on your chart, because then you're not going to do anything with it, right? It's not going to be actionable. So when it comes to the zones, the pre-market support, pre-market resistance, this is going to be the more aggressive area of support or resistance. This is typically going to be the area that has already been tested before the market even opens, which means that when the market goes down into that zone or up into that zone, it's going to be yet another test. It might be second test, it might be third test. The highest odds of response are going to be on first test of that zone during the regular trading hours session. The initial support and initial resistance zone are typically going to have more weight. Those are going to be the safer areas to trade. And again, that doesn't mean that you automatically have to enter at support or resistance, but those are typically going to be the better areas to look to trade off of. They are going to be the ones that provide you with the better entry. And then as we move beyond initial support, initial resistance, that's where you're going to have to watch the trade plan video, because usually I will talk about what the expectation is at any given zone. And of course, I'm not going to go over all of them in the video. I'm only going to go over the ones that I think have potential to get tested on the day time frame. It wouldn't really make sense to talk about zones that are 50 points away. So the morning video typically is 3 to 5 minutes. I try to keep it fairly brief, but there's a lot of content and information and analysis packed into those 3 or 5 minutes. So watch it a couple of times. I'm getting feedback from traders. One thing that I see that the traders who are doing better or performing well, what they do is they watch the video typically more than one time, right? They will watch it twice, sometimes even 3 times, and every time they watch it, they'll pick up something a little bit different and they'll gain a bit of an insight, and that just means that they're going to be really prepared for the trading day. The more prepared you are going into the day, the easier and simpler your trade execution is going to be in real time. And if you're not prepared and you're making all of your decisions only based on real-time information, then the results are going to be a little bit more random, I think. And it's not really going to make for the consistency that everyone wants, right? Everyone wants to be consistently profitable, and that is going to be difficult to do then. So now moving on to the trader worksheet. And I think this is very helpful. So looking at the trader worksheet, the first thing you'll note is that we have a summary of the previous day. So these are some key levels to be mindful of, even if they're not built into a support or resistance zone. So know what the previous day's high is, know what the previous day's low is. Quite often, these levels can act as key levels where either there can be a response, or how the market tests those areas can at least tell us something about the market. So the high and low usually is going to be an important level. The previous close, the previous VPOC, again, it's a good reference to be mindful of. And then we have the 3 p.m. Central Time close here. So this is essentially the cash closing price. And this is going to be helpful when we are reading the advanced decline line. So a little bit later in the webinar, I'm going to jump into the advanced decline, and then that part will make more sense. Now, the VPOC is a volume point of control, so that is the highest volume price from the previous day. So it just serves as a very short-term reference as to what the market considers to be fair value, right? So if a lot of volume transacted at a single price, that means that there was acceptance at that price. That means that both the buy side and the sell side saw that price as a fair price to do business, because that's the only way that a lot of volume would transact there, right? For every buy, there's a sell. For every sell, there's a buy. So, if you hear the term, oh, there are more buyers in the market or more sellers, that's never really the case. It's just that one side is willing to be more aggressive. So there can be more aggressive buyers in the market, and the sellers could be more aggressive. But in terms of more buyers and sellers, that's never really the case. It's just that one side can be more aggressive than the other. So in terms of the VPOC, or the volume point of control, that serves as a reference that tells us kind of what the market thought of as fair value on the previous day. Sometimes it can act as a key level, sometimes it doesn't matter. And that's why I say the market context is very important. It's not going to be a key level every single day. You have to look at the bigger picture. You have to see kind of where it fits in the larger time frame and kind of in the larger pattern that might be developing. After that, we have the directional bias and control section. And I think this is a very valuable area on the trader worksheet, because this is where we are finding out which side, if any, is dominant, right? Now, the short-term time frame is something where, if you had to assign kind of a time frame to it, short-term is typically going to be looking back 1 to 4 days. The intermediate term is going to be looking back maybe 1 to 3 weeks. And again, those are just ballpark estimates. And again, it's an oversimplification, I think, because just looking at 1 or 2 weeks of information may not be enough. It depends on how the market is set up at that point in time. And then the bigger picture is going to look at an even larger time horizon, maybe 4 weeks or more. But the idea behind the directional bias is that it's telling you which side, if any, is dominant on the short-term time horizon, on the intermediate and the bigger picture. Now, you have some environments like the one we're in right now where neither side is in control. And when that happens, you have to pay more attention and you have to give more weight to how the day is developing, right? Because there's no consensus on the short term, intermediate term, or the bigger picture, and neither side is really dominating any of those time frames, we have to then give more weight and more focus to how the day develops, because then that really dictates what the market could do on that particular day. And that's the type of market we've been in. But that's not always the case. There are markets where you can even get timeframe alignment, right? So this idea of timeframe alignment is where the short term and intermediate term are both pointing in one direction. Or if the intermediate, bigger picture, and the short term are all pointing in one direction. When that happens, it tells us which side to focus on. So as an example, here is a day, this is from March 9th, 2018, where we had time frame alignment going into the session. So if we look at this day, and then let's just quickly look at the trader worksheet for this day. And you can see that we have alignment on the short term and intermediate term, right? They're both bullish. So when you get that alignment either between the short term and intermediate term or across all three, then it tells you how to trade that day, right? This is very actionable information. This is not something where you just want to look at it and move on. I mean, this is something that you can really create some rules around, and it will help you figure out how to actually trade that day. So for example, if everything is neutral, what does that tell you? That means that we're open to both longs and shorts, and that we have to pay attention to how the market's developing a bit more closely during the day and see how the day develops. Is there one side that starts to take control during the day? And the idea is that when you take trades that are in direction of the dominant bias, they're going to have a higher probability of working out and reaching their profit target. So for example, if the short term becomes bullish, that tells you, okay, you know what, I'm going to be a little bit more aggressive on the long side, and I'm going to be more careful on the short side. So in that scenario, maybe we only take long setups at support zones and we use the resistance zones as targets. Or if we are going to short a resistance zone, maybe we wait for a more important or stronger area of resistance, right? So this directional bias section is going to directly have a relationship to how we trade that day, what type of setups we take, which side we focus on. And when it's neutral, we're very open. You have to be extra flexible when everything is neutral. But when this starts to change, When we start to get some real bias going on the short term and intermediate term, that's where we know, okay, we're going to focus on one side. And it doesn't mean that you can't trade the other side. Like I mentioned earlier, as day traders, we can usually find good opportunities on both sides. But what the directional bias and control section tells us is where are the better opportunities. Because you don't have to catch everything. It's unrealistic and impossible to catch every possible swing in the market. The idea is to have the odds in your favor, look for higher probability trade ideas, and when there is a bias in play, where there is a clear short-term bullish or bearish bias, intermediate-term bias, that is where if you take trades in the direction of the bias, you're going to have higher probability of that trade actually working out. Now, what about if short-term is bullish, but the intermediate and bigger picture is not, or the intermediate and bigger picture is even against the short-term? Well, that's where quite often you will get even more range-bound activity, where if the short-term does become bullish, but the intermediate is not, and the bigger picture is not, anytime the market runs into some stronger resistance, you'll get a response, or you'll be very likely to get a response. So if there is a clash between the short-term and intermediate, or the intermediate and bigger picture, that's where you can kind of see that tug of war taking place in the market, where you don't really get sustained movement. You might get short-term directional movement, but it'll be difficult for that movement to actually sustain and keep on going, because you'll run into either important resistance and then that larger time frame kicks in and pushes the market back down, or vice versa, right? So when you have alignment, that is going to be the environment where we're going to focus on taking trades in that direction. When you don't, that's where you're going to be open to longs and shorts. And when it's neutral, that's another time where you're going to be more open to longs and shorts. But the difference is that when it's neutral across the board, you still have to be open to the idea of a bias developing during the day, right? So when you're thinking of the market and you're thinking in terms of multiple time frames, you have the short-term, intermediate-term, bigger picture, but then you also have the intraday bias. That's something that develops in real time. And as day traders, we have to be very mindful of the intraday bias. And the intraday bias can also be neutral, bullish, or bearish. And in this type of environment, it's going to carry more weight because everything else is neutral. After that, we have the economic reports section. And it's good to be mindful of any econ reports coming out, because some of these reports can serve as catalysts for short-term directional movement. And if it's an important report, I'll typically talk about it in the morning video. And if we're heading into a significant report, usually it's a good idea to not be in any position. So that means be flat. Don't be holding a trade heading into a major economic news release, because a lot of times the market can get a spike in volatility, and you might end up getting stopped out for no reason whatsoever, and then later the idea that you had might actually work out. So most of the economic reports are not going to be like that. Most of them are not market moving, but then we do have some more significant ones, like the FOMC announcement, right? The Fed announcement is usually a catalyst for short-term directional movement. Typically happens at 1 p.m. Central Time. The employment report that happens on the first Friday of every month. Now that happens in pre-market before the market opens, but that is something that can serve as a catalyst. So it's important to just be mindful of these economic reports and understand that not every single one of them is going to be a major market mover, but some of them are significant. And if they are, then I'll talk about it in the morning video, which is why it's so important to watch that video. And then over here, I'm just showing the support resistance zones, but now I'm also explaining a little bit at least of what went into it. I can't cover every possible reason that an area is support or resistance. I think that would complicate things and it wouldn't really be all that beneficial, but I do try to include some of the reasoning as to why that zone was created. And that can provide you with some insight and perhaps give you a better idea on which ones are stronger, if there's more confluence at a given zone, if there are more reasons for that area to be a zone. Usually that means that there will be a higher probability of a response at that zone. And then the last section here is the 10-day range analysis. And I think this is very important as well, because one part of the market context is an understanding of the current volatility situation, right? You have to understand what kind of volatility environment you're trading in, because that is going to dictate how wide your stop can be on any given trade, and it's also going to help you figure out how big of a target you should use. For example, right now you can see that on the regular trading hours session, the minimum range we've seen over the last 10 days is 14.25 points, the maximum is 43.75, and the average is 26.75. So using this average range, we can get an idea on how big of a target is realistic. For example, last year we had, over the summer and even leading into post-September, an environment where the volatility was really low and the average ranges were really contracted. I think the average range might have been somewhere between 10 to 12 points back in the summer of 2017 and heading into even September. Well, if your average range is 10 or 12 points, your target is probably going to have to be less than that, right? You're not going to shoot for a 20-point target or 15-point target in an environment where the average range is only 10 or 12 points. And understanding the ranges can also help you figure out what kind of stops you should use. Because when volatility goes up, typically you will have to use wider stops. Now, you'll also get bigger targets, so it still works out, and higher volatility is typically a very good thing. But it gives you an idea of what your stop loss should be. So if you're dealing with a market where the average range is 25, 30 points, then you probably want to use about a 3-point stop at least in that type of environment. And then on the upside, you might even use a 5 or 6-point stop if necessary, because in an environment where you're getting 25 to 30-point ranges, you can quite readily get a 10 to 12-point profit target. And if you're using a 5-point stop, that still gives you 2-to-1 reward to risk. Now, a little bit later, we'll go into how we can even use this to project kind of the high of day or low of day. But this section, I think, is very important because understanding the volatility is very critical when you're thinking about the market context. And again, the context is everything. Particular setups work in particular environments. And if you're not in tune with the environment, then it's going to be difficult to make the right trading decisions. Okay, so now that we've covered the trade plan, let's jump into the recap video. So every evening during the week, I'll post a recap, and the recap video is going to explain the main trading opportunities for the day. And the intent behind the recap video is really just to educate and share some insights on a daily basis. And it's a way to get continuing education. Every recap is going to have some different insights, but there are patterns that you'll start to notice when you start watching them consistently. And again, the idea is to cover the main trading opportunity. It's not going to cover everything, right? There's not enough time. I think most people wouldn't really, everyone's busy. We're not going to have time to sit there and watch an hour video every day. So I try to keep the recap video between 10 to 15 minutes in length, and it really covers the main trading opportunities based on the morning trade plan, right? So I'll talk about, hey, here was our view going into the day, and based on that view and based on how we read the market in real time, these are some of the high potential and better reward opportunities that were available to us. And again, it's not going to cover everything. So if you took different trades than the ones in the recap, that's okay, right? It's not going to cover every single trade idea, but it's going to cover the main ones, the big ones, the main and high quality trades. That's what we covered in the recap. And then there's also going to be an element of teaching where, again, if you watch a few of these, you'll start to notice a bit of a pattern. And, some of the things are going to be repeated because that's part of learning. Repetition is part of learning. You're not going to learn just based on one webinar or one video. You have to actually see those ideas play out over and over again. And once you do, And once you see them in the recap, then after a while, you'll start to develop that pattern recognition and you'll start to see them in real time. So if you can't see it after it's already happened, if you can't make sense of it after it's already happened, there's no way you're going to be able to make sense of it in real time. So first you have to be able to kind of understand why the market did what it did, how the market set up, how the trade plan was put to use, how the market responded to these zones, and how to read the market in real time. That's one of the big benefits of watching the recap. And lastly, I look at the market as this developing story or this developing narrative. So there is this narrative to the market, which side's in control. How did today's market activity change the story, right? So it's this ongoing developing story. And by watching the morning trade plan video and the evening recap video, it's a very good way to stay in sync with that story, to be mindful of how the things have changed. Has the market environment changed at all? And if it has, what does that tell us about the overnight session? What does that tell us about things going into the next day? So to get the most value out of my work, you should watch the morning video, but then also watch the recap video, because there are going to be some nice lessons in every video, and you'll see them repeated over time if you keep watching them. But again, that's very good for trader development. And remember that trading is a game of skill, so it requires that element of skill development. And this is a great way to develop your skill on a daily basis. And if you make it a part of your routine, now you're very much in sync with, hey, here's what the market did today. Here's how that narrative has changed. Here's what that tells us going forward. And now here's the environment heading into the overnight. And then we pick it up again in the morning, right? So there's a cycle here. And if you're watching the morning and the evening video, that's how you can really stay in sync with that market narrative and that developing story. The last thing I'll cover on the website is the archive. So the website has been around since I think the end of March 2010. So at this point, it's been around for over 10 years. There are over 4,000 posts on the website. And if you are relatively new to the website, then you can quite easily spot check the analysis and see how well it's worked across different time periods, across different market environments, right? So this is very transparent. It's not that I'm only providing the zones for the current day and the plan for the current day. I'm letting you go back as far back as the website allows, right? Which again is the first post you can see was Monday, March 29th, 2010. Now, of course, during that time, I've gotten better. The way I explain things has gotten better. So if you go back to March 29th and you compare it to what I'm talking about today, you will see differences, and there should be, right? All of us are working on getting better every day. But the idea here is that if you are relatively new to the website, instead of having to wait for the daily plan to kind of see, hey, I'm going to see how it plays out, I'm going to see if it's worth my time to really learn this methodology, right? Because it's not about the money. I mean, this is a super low cost subscription. It's not expensive. It's not, I think most people who sign up, they're not concerned about the monthly fee for the website. It's more about the time commitment. Is this worth my time? Should I put in the time and effort to learn what this person has to teach me? To make that decision, a very good way to do it is to spot check the analysis, right? Just go back and kind of randomly pick a day, watch the trade plan, and then watch the recap and see how it played out. And you can test it against various time periods when the market was bullish, bearish, and everything in between. And all the analysis gets posted 30 minutes before the open. So that is a very good way to just kind of go back and build a bit of an understanding on how the method has worked across different environments. Like I said earlier, it's all about understanding the market environment, the market context. And by going through the archive, you can really develop a very good understanding of, hey, how does this method work across different types of environments? And once you do that, I think then it gets you to a point where you want to dig in a bit deeper. It gets you to the point where you make that commitment to watching the recap video. Now, the recap video, again, is 10 to 15 minutes, but still, it's a time commitment to sign into the website, to watch the video. And I know that everyone has super busy lives. So this is a way that you can kind of spot check it, but then that can then lead to developing that commitment to, hey, let me put a little bit of time into this. Maybe this is worth my while to really explore and learn and spend some more time on. So everything's in the archive, and the good, the bad, the ugly. And I'm not saying I'm going to be spot on every single day, but on majority of days, the plan works really well. No one hits it out of the park 100% of the time, and I have my off days too. So not saying that every single day is going to be amazing, but on majority of days, the trade plan is pretty spot on. So do check that out. So that covers the overview of the website. And I think that was important because anyone who's newer to the website may not really know how to get the best use out of it. And then there's also a video on the tagging feature. So I'm not going to talk about that in today's webinar, but if you go under important posts and click on tagging feature, this is a so this is a really good video too, and explains yet another feature of the website which can really help you in your skill development, because every post on the website is categorized and tagged. And so if you wanted to search for trend days or balancing days or momentum days, you'd be able to do that using that tagging feature. So that being said, let's now jump into trade execution and what I watch during the day. So if you've watched any of the recaps, you'll note that my charts are pretty straightforward. We don't use any of the traditional technical indicators like moving averages, MACD, stochastic, Bollinger Bands. There's a host of different technical indicators that are out there, and I've tried majority of them. I think that's kind of the path that we all take, is that when we first get started in trading, we are kind of enamored by all these indicators, and we think that they are predictive, and we start playing with them and messing with them, and they look great in hindsight, but in real time they never gave me, at least, the results that I wanted. So not taking a dig at the indicators, maybe there is a way that people make them work, but I personally could not make them work for me. And over time, I started eliminating the indicators from my screen. So like if you saw my screen back when I started, which was in 2002, 2003, it was very messy. I had a bunch of indicators, stochastic lines and RSI and all this other stuff that really didn't provide me with an edge, but it gave me that false sense of security that, if all these things are lined up, then maybe it gives me some sort of predictive power over the market. And maybe that increases the odds of the trade working out, and that just never ended up being the case. They would always look good in hindsight. They never worked well in real time. So over time, I just ended up taking all of them off one by one, and I'm left with what you see now. So if you look at my chart, there isn't really any mathematical or traditional technical indicator. The only one that you might see is the VWAP, right? The volume weighted average price, which is over here. But all the other lines are reference lines. They're not some squiggly line mathematical indicator that I have no idea how it got calculated. Everything else that you see on here is more of a reference, right? So we have the first hour high, we have the first hour low, we have the extension of the first hour range. This is the 50% extension. This is the 100% extension. We have the overnight low, overnight high. But again, these are references. This is not a technical indicator. We have the midpoint over here, which is literally the middle of the current day's range, as the name would imply. And then the only other indicator we use, which again is not a mathematical indicator, is the advanced decline and the NYSE tick. And I'll get into this a little bit later. But in terms of the time frames that I watch the 5-minute mainly. The 5-minute chart is really my primary setup chart. That is really where I visualize the trade setup. And if I had to use only one time frame for day trading, it would be the 5-minute chart. I think it's a very clean time frame and it works really well for what we're trying to do. But at the same time, I am watching the 30-minute chart at all times. That gives me an overview of the bigger picture. So I always keep a 30-minute chart up as well, and I'm very mindful of how that's developing. And then I will have a 1-minute chart with the AD and the tick, and you can see that chart in the recap videos as well. And the 1-minute chart is really more for execution purposes. That's really just to kind of fine-tune execution. It's not my setup chart. I'm not making trading decisions just based on the 1 minute. The 1 minute can help me with timing. It can help me with kind of seeing how a pattern is developing underneath the surface. But if I had to use only one chart on the day time frame, it would be the 5-minute. And then after that, I would add the 30-minute chart because we have to be mindful of the bigger picture. Even though we're trading on the day time frame, we have to be mindful of what's happening on the larger time frames. And the 1-minute chart is the one that I would eliminate. I think that's the chart that causes the most confusion for people because it is such a small time frame and there's a lot of rapid pattern development happening on that time frame. So, an idea that you might be familiar with already is that the markets are fractal, right? And what that means is that if I basically took off, the time axis on this chart and the daily chart, you really wouldn't be able to tell what time frame I was showing you, right? There are patterns taking place across every time frame, and if I remove the time axis here, you wouldn't be able to tell whether this was a daily chart or a monthly chart or a 1-minute chart. The difference is that any pattern that happens on the 1 minute is going to have an impact that is the same as that 1-minute chart, right? So a small 1-minute pattern is not going to be earth-shattering. It's not typically going to result in a big move. A pattern that takes place on a 5-minute will have more of an impact on the market. And similarly, a pattern that takes place on 30-minute will have an even bigger impact on the market. But at the same time, a 5-minute pattern might take 5 or 10 bars to play out. That means that it might take half an hour to an hour to play out, whereas the same pattern on a 30-minute chart might take a few hours. The same pattern on a daily chart might take a few days. So whatever time frame you're watching, just understand that the impact of anything happening on that time frame is going to be in accordance with how big of a time frame it is. So a 1-minute chart I think confuses a lot of traders because number one, the patterns are developing very rapidly, and number two, they don't quite have the impact on the market that one might look for. And I think the problem is that as discretionary traders, we are very visual, and when we see a pattern on a 1 minute, we might accidentally give it more weight. And that's really where the problem kind of, I think, arises from, is giving that 1 minute chart too much weight, and that results in all kinds of different mistakes. So if you are a newer trader, you're probably better off only watching the 5 minute and the 30 minute and eliminating that very fast time frame like a 1 minute, or even changing the 1 minute to a 2 minute can actually really help. But don't get lost in that micro or very small time frame. Always be mindful of the 5 and the 30. And there's no magic to these time frames, right? It's just a way to group the information. It's just a way to chunk the data. At the end of it, the information is the same. It's just that on a 1 minute, it's more granular. It's going to allow me to peek into this 5 minute bar and see how exactly it developed. But the overall information in terms of swing highs, swing lows, breakouts, breakdowns, that kind of stuff, that's going to be the same. It's just more granular in nature, but overall, we're still getting very similar information. It's just that, on the 1 minute, we get to see it in much more detail, kind of under a microscope, right? And there are even smaller time frames than that. these charting providers have now even gone down to a second chart. I think TradeStation even has that. They have a second chart, which it's of no use to me, but maybe it does benefit some people. But for day trading, for the way I look at the market, a 30-second chart would be completely meaningless and useless. It wouldn't really help me that much. So if you have to use one time frame, the 5-minute works out really well. And when you're thinking about the information that you're looking at, you have to give more weight to price action and the market structure, right? So that is first and foremost what I look at, is the character of price action. And what I mean by that is how easily is it moving in one direction, right? What is it trying to do? And how good of a job is it doing in moving in that direction? Or is it just very choppy and two-sided? So price action itself and the character of price action itself is going to be the first thing that we look at. And that is going to get the most weight, because when you're putting on a trade, it's the price that's going to pay you, not some indicator or something else, right? The market has to move in order for that trade to work out. So we always give more preference to price action. The combination of directional bias and the key support resistance zones has provided me with the best source of edge, right? So over time, what I've seen is that the best source of edge is when you combine that directional bias, which inherently takes the market context into account, and then you combine that with the key support resistance zones. Now, for example, this was the pre-market support, which is the aggressive one, right? So we're going to be careful here. We don't have to necessarily trade this. This was initial resistance. We know that's going to be the better zone on the day. This was initial support, right? And you can see that in this case, the market ended up responding just 3 ticks ahead of that. Now, anytime the market gets within even 2 or 3 ticks of the initial support or initial resistance, and then there is a swing that kicks off from that level, we will consider that zone to be tested. The highest odds of a response are going to be on first test. That is going to be the highest probability trade, is going to be on first test of that zone during the regular trading hour session. And if the market has already responded to it, 2 or 3 ticks ahead of it, we will consider this to be the first test. And then when it comes back down to it again, we're going to consider this to be the second or even third test of that zone. And that requires caution, and it calls for being very careful. And we're not just going to blindly trade this zone, right? But the first time up into it, that's where it's going to provide the highest odds. So I'm just going to include some basic principles, some tips on when to take the trade. Like I said, the best source of edge is a combination of directional bias, right, which is covered on the trader worksheet, and the key support resistance zones. In this case, our directional bias is neutral today. So that means that when the market gets overextended or exhausted into resistance, we can just take the trade. Okay, we don't have to wait. So one thing that really sets this methodology apart from many of the methods that are out there is that we do not wait for price confirmation. So what we're doing is we are really in tune with the market environment. And if it's a balancing type of environment, or an environment where the bias is very neutral and the market gets exhausted into a zone, we're not going to wait and see, oh, are sellers stepping in, and then make our decision. No, we will just take the trade with the full understanding that it may not work. So this is where you can actually use resting orders. And I think resting orders are underappreciated, and most traders don't realize how powerful of an idea resting orders really are. So when you have a defined support or resistance zone, and you understand the environment, which again is covered in the morning video. So the morning video is telling you what kind of environment you're in. The directional bias is telling you if one side's very dominant, and then you have the key zones. So that's really the whole equation right there. I mean, that's 95% of it. So when you have that, and the market you see is getting extended into it, you don't have to wait for the market to get here. You can just have a resting order. And one question that I get quite frequently is, Well, you have these zones that are, roughly 2 points, sometimes 3 points wide. Where in the zone do I place my order? Okay, I'm willing to place the resting order, but where do I place it? Beginning of zone, middle of zone, end of zone. So the way to calculate, or the way to figure out where to place the entry, is to first start with the stop loss. Most traders are only concerned with the entry, and the stop and the target is an afterthought. And it's usually kind of a fixed stop or target, and that doesn't really work well. You have to start with the stop, and the stop must be placed at an invalidation point, right? It has to be placed at a price where if the market got there, at least that short-term trade idea would become invalidated. It doesn't mean that the whole day structure has to change or something like that. It just means that, hey, that idea that you were going for is now invalidated, and now the market can do something else. So the first thing is to determine where can I place my stop. So in this case, for example, we have the zone at 81 to 83.5. As a rule of thumb, you want to place your stop about a point behind the zone, okay, just to be safe, because sometimes the zone will get taken out by a tick or two. So you don't want to get stopped out prematurely and then see the trade work out in your favor. That to me is the most frustrating thing. So you want to place your stop at least a point beyond the zone. Now, in instances where there is another key level right behind the zone, you can use that. So in this example, we have the overnight high at 84.75. So you can place your stop at 85. So you start with the stop. That's the invalidation point. If the market breaks the overnight high, clearly the short side is not really the one to be playing. So we're going to get out of our trade at 85, right? So the stop goes to 85. Then you think about the target. Okay, if this is successful, if this zone does indeed hold, where could the market go? Now, one way to set that target is to just use a previous zone. Another way is to use one of the key levels, like the midpoint or like the first hour high, right? Now, in this case, even if you're using the mid, you can see that one ends up being about 75.5 or so, 75.75. And if you're waiting for this zone, the 71 to 73, that ends up being a pretty nice target as well. So you start with a stop, 85, then you say, okay, what's my target? So let's say we set it down to 73, right? Because this is not a very directional day. The directional bias is very neutral, and we're not expecting the market to take this area out. So if it stops here, it could very well drop right back into the first hour range. It could very easily drop into the mid and even lower. So start with 85, figure out where your target is, and then based on the stop and target, determine where in the zone you can have a resting order that will still give you at least 2-to-1 reward to risk. Now, when you have a bigger target, you can be more aggressive with your entry, right? That means you can short even 81. So if you short 81, stop 85, all you need is 8 points, right? You don't need a huge move. You just need an 8-point move to get 2-to-1 reward to risk. Now, if you short a little bit into the zone, what does that do? Well, that improves your reward to risk, because now the stop is going to be a little bit smaller, right? You don't need a 4-point stop. See, the main thing is that the stop has to go at the invalidation point. That part is non-negotiable. It has to go at the invalidation point. The stop cannot be moved around. You don't want to mess with the stop. The entry is where we have some leeway. That we can play with, but the stop is 85. Now, if you short 81, it's going to be a 4-point stop. You short 82, okay, it's going to be a tighter stop, right? It'll be a 3-point stop, which means you'll get either better reward to risk, or you'll be able to use a smaller target and get out even earlier and still get 2-to-1. Now, 2-to-1 again is the minimum. 2-to-1 reward to risk is the minimum that we go for, but ideally you want to shoot for even 3-to-1. And then anything over 3-to-1 would be considered a home run on the day time frame, on the time frame that we trade. So that's how you can figure out where the entry could be. And typically, beginning to middle of zone is going to work well, because if you start being too selective and putting it all the way at the edge of the zone, you're going to miss a lot of trades. So you don't want to be too particular with the entry and try to be overly cautious and overly selective, like, no, I need to go back of zone. anywhere in the zone is considered good trade location. Now, of course, the further into the zone you go, technically the better location it becomes, but anywhere in the zone is considered good trade location. But where exactly in the zone, that is where you can use this stop, target, entry technique, right? First think of the stop, then the target, then figure out what is a good enough entry where you'll get at least 2 to 1. And that can give you a very good idea on where to place that resting order. And then once you have that resting order in the book, in your trading platform, then you simply allow the market to come and fill you. And if you don't get filled, that's okay too. That's part of trading. There are going to be instances where you have a resting order, the market gets very close to it, and you don't get filled. Now, if the reward potential is very high, that's where you can make that manual decision to just get in, maybe even 1 or 2 ticks ahead of your intended entry price. Again, it depends on the target. If the target's big enough, then you can do that. And the stop doesn't change, by the way, right? The stop is still going to be 85, irrespective of where you get in. But depending on where you get in, you'll have a different reward to risk on that trade idea. So that is how you can figure out how to do it. But before you even get to that, the main question is, should I even be shorting this market? And that's why I say that the best source of edge is a combination of directional bias and the key zones, right? The key zones are not meant to be traded in a vacuum. They are meant to be traded in conjunction with the morning trade plan and an understanding of the directional bias. And then, of course, you still have to kind of know how the day is developing too on most days. And is it first test of the zone? Well, that's going to increase the odds, right? So the first thing is understand the environment. Does the environment support the idea of fading the zone? If it does, then just take it. Then we're not going to wait for confirmation. Worst case scenario, we get stopped out. And that's okay. That is a part of it too, right? You must be willing to get stopped out in order to capture the best opportunities. If you're not willing to get stopped out, then you're just not going to take any trade, right? So that's a very good way to take advantage of the zones, the trade plan, and actually profit from the analysis as opposed to just see it working and kind of at a theoretical level, right? Kind of see it working every day, but not taking advantage of it means that you're not really sticking with the method. You haven't perhaps developed enough confidence in the method. And that's where watching a bunch of recap videos can show you, like, hey, there's some consistency here. If you simply trade at the zones and are mindful of trade location and bias, you can actually do fairly well. And then if we're setting up for a directional type day, or a big breakout or breakdown is taking place on a larger time frame, which will usually be reflected in the directional bias, well, then you don't take zone fades against that directional bias. Then you trade with the trend. Then you try to find opportunities where you can get on board for that directional move. And that's the methodology in a nutshell. When the market's balancing, we're looking to fade zones. When it's going directional, we're trying to get on board and stepping out of the way. We're not going to fade zones on a very directional or trend type day. And if you watch that video on the tagging feature, you'll see that you can actually go back and study trend days and balance days and everything in between by using those tags. And trading is a game of skills, so the more skilled you are, the better you're going to trade, right? Now, at this point, let's jump into the market internals, or the market breadth indicators. And again, these are not your traditional, technical indicators that are purely kind of mathematical and just a derivative of price, right? This is unique information. So the New York Stock Exchange Advanced Decline Line is a measure of the number of stocks overall that are trading above or below their previous day's closing price. And this is why I list the 3 p.m. Central Time close on the trader worksheet in the previous day's summary. Because you have to be aware of that previous day's close at 3 p.m. Central to make sense of the advanced decline. Because the advanced decline line is based on the previous day's close. And the idea is that in terms of the absolute value of the AD, when the market is trading at or near the previous day's 3 p.m. Central Time closing price, you would expect the advanced decline value to be somewhere around 0. And if it is very different than that, then that's where we say there's a bullish or bearish disconnect, right? So this idea of a bullish or bearish disconnect is that we expect the AD to be at a particular value, but it's very different. So a example of that is over here. So just actually even from April 20th, there's an example where the market's trading at the previous day's closing price, but if we look at the advanced decline line, it's actually fairly bearish already, right? It's not around 0. And even when the market was trading above the previous day's closing price, the advanced decline line was still in negative territory. So it tells you that underneath the surface, looking at the broader market, there's some weakness there, right? And that can make it difficult for the S&P to go higher. So this is one way that you can use the advanced decline, is by looking at the absolute value, but in relation to the previous day's 3 p.m. Central Time closing price. The other way that the AD line can be beneficial is when there are very notable divergences, right? The market makes a new high on the day, but the advanced decline line does not. Or the market makes, a major low on the day, but the AD line is making a very notable higher low. Now, when it comes to divergences, they should be very obvious. So what I mean by that is you should not have to zoom in and look at it under a magnifying glass on a 1-minute chart to spot the divergence. Those divergences don't matter. The ones that matter are clear and obvious, and they're very apparent. Those are the ones that make a difference. And the last thing I'll say on this is that the advanced decline line is helpful when it's providing us with some unique information, right? So a lot of times the AD line will move in sync with price. Price will go up, AD will go up. Price will go down, AD will go down. So quite often, it doesn't matter what the advanced decline line is doing because it's just moving in sync with price. There's nothing to read into. The only time we use the advanced decline line and we factor it into our trading decision is if it is giving us some unique insight that is not already visible to us in price. And the only time that happens is if there's a notable bullish or bearish disconnect on the advanced decline, or there's a very clear and obvious divergence. And in an event where the divergence doesn't work, like you see a divergence but the market keeps on going anyway, that is still good information. That means forget the advanced decline, give more preference to price. If the market's continuing in one direction despite a divergence, that means that the market is pretty set in moving in that direction, and the AD line is not really providing much value in that specific instance. So price is always king. Price action is always going to get more preference. But if you are going to use the advanced decline line, then don't factor it into every single trading decision. That's a very common mistake I see, is that traders start to factor AD into every decision they make. And on many trades, the AD is irrelevant because it's not providing us with any information that is not already visible to us in the price action. So don't give it too much weight. Don't overweigh the advanced decline. Only use it when it provides you with unique information, new information that is not visible to you in the price action. And the only time that will happen is if there is a bullish or bearish disconnect, or if there's a very clear and obvious bullish or bearish divergence. Every other time, it's not really going to give new information. In today's case, you can see that the AD line started making new lows in advance of the market making new lows, right? So that's something where it provided us with some new information that wasn't visible to us in the price. The other indicator we look at is the NYSE tick. The NYSE tick is more of a momentum gauge. So it is a measure of the net number of stocks that are trading on an uptick versus a downtick. And when it comes to the tick, you want to look at where it's spending majority of its time, and you want to look at the readings that it's printing above zero versus below zero. So you're not going to draw trend lines on the tick. We're not going to look for divergences on the tick. For the tick, we're really looking for that momentum. And in order for there to be sustained momentum, the tick has to have a distribution. That means that it has to hold above zero or below zero for, at the very minimum, 20 to 30 minutes for there to be anything that's noteworthy, right? So if the tick is just going back and forth, that simply tells you that you're in a very balancing type environment. You're in a range-bound environment. But when the tick starts to hold on one side of the zero line, and not just hold on one side, but print some decent values in that direction, that's where you get the idea of sustained momentum. So as an example, you can see that over here, if you look at the overall skew of the tick, it's mainly below zero. And it's not just that it's minus 2, 300, it's printing some nice notable values, right? Around minus 6 to 800. And even though it comes above zero for a little bit, the downside completely outweighs the values we see on the upside. So as the market is kind of heading lower over here and just consolidating within a range, we know that the probabilities overall favor the market going lower because AD's already made new lows and the tick is completely below zero. So at this point in time, based on this much information, we would still expect the market to go lower rather than go all the way back up. And again, this is a game of probabilities, so you're not going to be right every single time, and that's okay. You don't have to be. The main idea is that when you're right, you're getting paid 2 to 3 times your risk. And when you're wrong, you're losing 1 times your predefined risk. So over here, you can see that eventually that leads to a downside move. Now, I'll also bring the trader worksheet back in here for a second and go over the range analysis one more time because that's interesting here too. So one way that you can use the range analysis is you can figure out what the eventual high or low of day might end up being, right? So over here, for example, we know the RTH average range is 26.75 points. And typically after the first hour, the high of day or the low of day will already be set, right? About 70% of the time, the high of day or the low of day gets established in the first hour. So that means that after the first hour is up, you can try to figure out, number one, is the low of day in, is the high of day in, right? That should be the first question. And when it comes to determining is the high of day in, is the low of day in, it's not as simplistic as just saying, oh, I broke above the first hour high, so low must be in, right? That would be overly simplistic. The time where you can really say that, hey, the low of day may be in is when the market is breaking outside of the current main range or balance area on the 5-minute chart. So in this case, if we had broken out above the overnight high, then we would say that the low of day is probably in. And then we would take the low of day, which at the time was 67.5, and we would add 26.75 points to it to figure out what the eventual high might be, right? And it's not, again, as just simple as first hour high, first hour low, but it's a good guideline because usually the first hour range will coincide with the main range that is in play, but not every day. Today you can see the first hour high does not coincide with the main range that's in play. So when we break out, we have to look at things holistically, and we have to look at it contextually. And we say, well, we failed at initial resistance. This was the main area on the upside. Momentum is bearish, right? AD line's making new lows. So if we had to make a bet, we would say high of days in. Now, again, you never know, but it's a game of probabilities. So based on this picture, we would say that the odds favor the high of day being in. Okay, well, if the high of day is in, and in this case you can see it's 83, well, then we can subtract 26, 27 points from that to figure out what the eventual low might end up being, which would give us this 56 quarter to 57 quarter zone, right? It tells us that this zone is within the range potential of the day. It can get tested. Now we can use that insight and then we combine it with the fact that this is second test of the initial support zone and we don't trade here. So you have to kind of put that whole puzzle together to get the best results. It's not just about one simple rule or just one little concept. It's when you put it all together that you get the best results. So over here, we know that first test of the zone provides the highest odds of response. We know that if it happens within 2 or 3 ticks, we can consider that to be first test. We combine that with the AD making new lows, tick being completely, for the most part, below 0. This being the main zone on the day. Well, when you combine that and look at it holistically, the odds favor the market extending the range to the downside. And based on the range analysis, we know that this 56 quarter, 57 quarter is within the range potential of the day. So if we get an average range, it can happen, right? It can test that area. So what does that mean? Well, that means we're not going to trade this zone, number one. If we're trading this zone, we're going to be careful because we know that it could extend to the next one, right? So we're not just going to hold it blindly. You can see first test, we still get a response, right? First test has the highest odds of response. We still end up bouncing about 5.5 points, right? But then we go down and test 57 quarter. This is another area that can be traded on the long side. There is confluence here now because this is also the 100% range extension of the first hour range. This level on its own in a vacuum should not be used, but when it coincides with a zone, that's where it can provide a bit of extra confluence and help that trade idea. So the market is exhausted into it. You can see that the move started at about 74.5 up here, straight line down, very minor bounce, and now down into it. So we've gone from 74.5 all the way down into 57 quarter, right? And you can look at the trader worksheet to see what the zone consists of. And you'll see that there's an open gap, there's a naked VPOC, I think, there's a high volume node there. So there is a lot of confluence here for this area to act as support. And this was also covered in the morning video, that buyers can be active there in the event that the market tries to break down. Unless we're seeing excess weakness or some, trend down type conditions, buyers can be active here, especially if the market's exhausted into it. So you can see that to take advantage of this, the best way to do it would be to have a resting order. Now this is a 1 point zone, which means you could get in even a little bit ahead of it and still your stop loss would only be 2.5 or 3 points. And on the upside, what can we target? Well, we can target a move back up to the overnight low. At the very minimum, we would look for at least a move back up towards the overnight low. We know that broken support can act as short-term resistance, so that would be another reason to take profit here. And eventually you can see we end up going even higher, but you don't have to necessarily hold it for that. You can just take profit even around the 65, 66 area, and that would still give you very good reward to risk. So when you put it all together, that is where you're going to get the best results. But of course, in order to put it all together, you have to understand the puzzle pieces individually. So you have to understand them individually on their own and then see how they fit as a whole and what the relationships are between them. And when you study that and develop an understanding of that, that's where I think you start to get better results. You start to get a better understanding of how the markets work, how to trade them, and that's how you work towards becoming consistently profitable. But the best source of edge is going to be the combination of directional bias and the zones. And then these are just some other indicators, the advanced decline line, the tick, that can help us gauge what kind of momentum we're dealing with. Are we seeing excess bullishness or excess weakness via the advanced decline? And these are good insights. They provide us a little bit of a deeper view on how the day is developing, but they are not a requirement. The methodology would work fine even if you were trading crude oil or gold or some other market. Now, those are not markets I trade, but my point is that if I were to trade gold or crude oil, I would do it the same way. I would develop, the key support resistance zones. I would understand the directional bias for that market, and I would trade accordingly. And those markets don't have internals. So These are not a requirement, but they are beneficial if you know how to use them. Any tool is only going to be as useful as the understanding of how to use it. Once you know how to use it, then it's beneficial. But if you don't, and you start to kind of look for, for example, you start to draw trend lines and things on the tick, like that doesn't matter, right? A trend line on the tick is irrelevant, so you don't have to do it. Now you can draw a trend on the AD, that's kind of helpful, but on the tick it's completely irrelevant. So that covers our NYC tick, AD, what we look at on the day time frame. The final thing I'll cover on zone fades is the beliefs that you have to have in order to consistently trade the zones. So number one, you do not need additional reasons to take a zone fade. The zone itself is enough of a reason to take the trade, right? So when we come up here, we don't have to look underneath the surface and be like, oh, but the tick's doing that, AD is doing this, and this other thing is doing that. You don't have to overcomplicate it when it comes to execution. The zone itself is enough of a reason to take the trade, and that has to be an internal belief in order to execute correctly and consistently. After that, understand that it's not about this zone working. That's a very common mistake, that a trader will fade one zone and then skip the next one. Well, fine, that zone didn't work. It has nothing to do with the next one. The next one can still work. That stands on its own. So it's not about this zone working. It's not about this trade working. It's about the results you can get when you bunch the trades together, right? You need a large enough sample size to make heads or tails of any of your results. So you can't measure yourself on a daily basis. You can't judge yourself on a trade-by-trade basis. It's better to look at how you did over a 2-week period or 1-month period. And that's how you should judge the performance of the zones as well, and your trades at the zones, right? It's not about this zone working. It's not about this trade working. And then as long as you're in an overall balanced environment or a range-bound environment, for the most part, anytime the market gets exhausted, first time into initial support, initial resistance, or another zone that has sufficient confluence, for the most part, you can usually just fade it, and you don't have to look for anything else. The market being exhausted into a zone in a balanced environment is a very high odds trade setup, and you can just take it. You don't have to look for anything else. That alone is enough, and then where to enter in the zone is determined by stop target entry, and then you execute based on resting orders. So it becomes a very simple way to trade. It's not about reading the 1-minute chart and having to make these decisions on the fly. You can have that trade set up long before the market gets there. We knew 5750 was the 100% extension way before it got there. We knew the 56 quarter, 58 quarter could get tested, even as the market was just struggling over here with all of these other bearish signals. So you don't have to wait for it to get there and then in real time click the order and make that decision. You can pre-plan your trades. And by pre-planning the trade, you've kind of thought it through, right? It's not an emotional decision when you've placed that order an hour in advance. The emotional decisions happen on the fly, in real time. That's seat of the pants trading. That's what the majority do. They're kind of at the whim of the market. They see a big upside bar. I can guarantee you, as soon as someone saw this upside bar, they started buying this very minor pullback. Even though this upside bar is just one bar within this big range, in the context of this big downswing. See, everything is contextual. So just by having one isolated upside bar, it doesn't mean anything. But I can guarantee you that many traders saw this upside bar, started buying it on a pullback of the bar itself, got stopped out, and then saw the market go up to the resistance zone. See, over here, there's no invalidation point, right? Where do you put your stop? Does coming down to the bottom of the bar mean anything? It doesn't. Does even testing this mean anything? Not really. Like, you'd have to break the overnight low for anything meaningful to happen. Just like you'd have to break the overnight high up here for anything meaningful to happen. So the traders that are trading kind of at the seat of their pants are at the whim of the market. They're usually chasing the market up and down and typically caught on the wrong side. Just like traders bought over here, I can guarantee you there are traders who bought over here, right? They saw this breakout, and yes, it's a break from this little range, but this range is not in isolation. It is part of the big one, and this is the main resistance area. Many traders saw this upside bar, they saw the breakout, and they started buying it. And that's why there's a resting period up here. You see how we don't just hit it and turn around immediately? Why is that? This goes back to looking at the market through the lens of market participants. It helps us make sense of what's going on. Why are we just holding up here? Well, because when someone sees this breakout, they start buying it. Anyone who's not aware of the market context is trading just based on what they're seeing in real time. They see this breakout, they start buying it. That short-term buying that comes in acts as a little bit of a buffer of support. That's why the market hangs up here. But eventually that short-term buying runs out. And then those guys get stopped out, right? So when you look at the market through this lens, it really helps make sense of what's going on. It can give you the confidence to stick with your trade, right? So if you're short over here, don't let this little sideways activity scare you out of your trade. Most decent moves happen after a bit of balancing at the zone. Most moves are not like this, where it just touches it and turns around. A lot of good moves require a bit of balancing, a bit of consolidation before they kick off again. And that's not a bad thing. More people are getting sucked into the wrong side up here. That helps your trade if you're short. It doesn't hurt it. You can see as soon as we go back up here, the momentum just dies off, right? The tick just kind of starts being very mediocre. In order to get any sustainable movement, you need sustained momentum, right? So there are basically two types of trades you're taking at any given point in time. You're either taking a momentum-based trade or you're taking a location-based trade. A momentum-based trade is when you're getting on board because there is some directionality in the markets, and a location-based trade is when you're fading a key support or resistance zone. Those are two main types of trades. So anytime you're taking a trade, you can ask yourself, what type of trade is this? Is it location-based or is it momentum-based? If it's momentum-based, is there sustained momentum? Because if there isn't, you're probably about to get run over. So I hope this helps you trade the zones. And at this point, I think we're about an hour and a half into it. So I will wrap this up here from my side. And now we'll jump into the Q&A portion. So I'm just going to start going through it one by one. So one of the questions here regarding the zones is, do you wait for a reaction? And this is a question that was emailed in, to be fair. The question is, do you wait for a reaction at the zone before you take the trade? And the answer is no. If the environment supports the idea of fading the zone, then we're just fading the zone. We're not waiting for any kind of confirmation from price. Okay, so one of the questions here is, if the tick is positive and I'm seeing plus 1,000 and the price action is going from initial support to initial resistance, how do I figure out whether to short initial resistance or whether it will break initial resistance? Well, you never know for sure, right? That's one of the things with trading, is that you never know for sure what's going to happen. I mean, if we knew for sure, it would be very easy for us to know what to do, right? So in terms of how do I figure out whether to short, it goes back to understanding the market environment. As long as we are still in a balancing type of environment, you can take it. So you will short it either if it's still in a balanced type environment, like you're not seeing trend type conditions, right? And there are many videos on the website that talk about trend days and the conditions that produce trend days. So I suggest going back and watching videos on trend days. I've covered it many, many times. So as long as we're not in a trend day, typically you can just outright fade initial support, initial resistance on first test, right? So it's going to work much better in the first half of the day as compared to the afternoon session. So as a general rule, fading the zones in the last hour comes with more risk. Again, it doesn't mean that it can't work, right? Anytime we say more risk, it just means the probabilities are a little bit lower than the morning session. But it doesn't mean that there's zero, right? So it just comes with a little bit more risk. But if it's happening the first half of the day on first test and you are not in a trend day, you can just fade it and it should be okay. And if it doesn't work, that's part of trading too, right? Not every zone's going to work. Not every trade idea is going to work. The next question is, what does the yellow line in the sand indicate? I don't see it on the daily worksheet. So the idea behind a micro bull bear or a bull bear line in sand or bull bear zone is that it helps us figure out which side is in control. Now, not every single day is going to have a bull bear zone. On many days, the market is just range bound. So neither side is in control. But there are instances where we'll have a bull bear zone. And the idea is that as long as the market's holding above it, buyers still have a shot at maintaining control. And if you break through it, then that control shifts from the buy side to the sell side. And then from there, if you continue holding below it, the sellers are in control. So the unique thing about a bull bear zone is that it tells us which side is dominant. It serves as not only an entry point or an exit point, but even a reference to help us determine directional bias. The other term you'll see in the trade plan is micro bull bear zone. The micro bull bear zone is a similar concept, but it's on a much smaller time frame. So the micro bull bear is really going to be relevant off the open, perhaps in the first 30 minutes or so. And then as the day progresses, it will start to become less and less relevant. But the principle is the same. The idea behind a line in sand or a bull bear zone is that it tells us which side is in control. Now, in terms of seeing a yellow line on the chart, keep in mind that not all of the yellow lines are going to be representing a line in sand. For example, this yellow line up here is a reference pointing to the overnight high. And other times there might be a reference to a previous VPOC or a previous close or an open gap. Those are all going to get displayed as a yellow line. That's why you have to actually look at the key zones chart and the trader worksheet and see how that zone is defined. If it doesn't say bull bear zone or micro bull bear zone, it'll say something else, and that's what that line represents. But that's the idea behind the bull bear zone, is that it actually tells us which side is dominant and in control. The next question is, please share your thoughts on how much one should have in their trading account to get the best results. Now, as I'm sure you all know, you can start with as little as $5,000. And if you watch the risk management webinar, you'll see that we use a percent risk model. So we risk a fixed percent of the account on every single trade. Now, of course, the smaller the account, the smaller the return is going to be, right? But that doesn't mean that you can't start with 5K. You can start with as little as $5,000, even $10,000. And actually, if you do the right things, you can build that account pretty quickly. I had a student who started with, I think, roughly an $8,000 or $9,000 account, took it to, from what I recall, about 16 in a single month. And because he was using percent risk, as the account grew, his risk in terms of dollars per trade grew. So that means that it was easier for him to go from 16 to 25 than from 9 to 16. And that's what he did. He went from 9 to 16 in 1 month. And then the next month he went from 16 to a little over 25. And just took it from there, right? So even if you're starting with a small account, as long as you're doing the right things, or at least as long as you're doing more of the right things and less of the wrong things, you can still come out ahead. The benefit of trading a methodology that is high reward to risk is that you don't have to get everything right. You don't have to be perfect with your execution. You can make mistakes. It's okay. There is enough reward potential in the methodology that it will accommodate those mistakes. So not everything has to be done perfectly. As long as the good outweighs the incorrect, you'll be fine. But you have to get that. You have to get the good stuff too, right? You have to get those high reward potential trades. But as long as you're getting those, you can make some mistakes. You can have losses. That's part of it. but I'm talking about not losses that are part of the system, but I'm talking about losses that are purely from mistakes or just oversight or missing something, right? So when it's an actual trading error, not just a scenario where the trade idea was good, it just didn't work out, right? That's part of the system. That's going to happen. But then beyond that, there are trading mistakes, emotional trading decisions. I'm saying that there is enough reward potential that it will accommodate even those, as long as you're also capturing the main trade ideas on the day. So in terms of a minimum, you can start with even 5 or 10. Now, of course, if you want to do it for a living, you're going to need a higher balance, right? And that's going to vary from trader to trader, depending on what your expenses are, how much you want to make, and that's very personal for every person. But in terms of starting out, 5 to 10K is sufficient. Of course, more is better, right? It makes it easier to manage risk when you have a account that is at least 20 or 30K, but it's perfectly okay to start with even as low as 5 or 10. The next question is the 2-to-1 reward to risk from the front of the zone or from the extreme edge of the zone? So when it comes to reward to risk, it's based on your entry, right? So it's not based on the beginning or end of a zone. It's going to be based on your entry, and that's what's going to matter, right? You have to figure out where in the zone, if you took the trade, would you be able to get that 2-to-1 or 3-to-1 reward to risk? Sometimes it'll be from the beginning of the zone. Sometimes it'll be middle of zone. Other times it might be the absolute back of the zone. But the reward to risk calculation has to happen based on your entry price. One question here is, which range do we add or subtract when looking at the 10-day average? So you can use the RTH range for the RTH session, but you can also use the 24-hour range. So for example, over here, when we look at the trader worksheet, you can see that on the 24-hour, the average is 35.25 points. But when you're using the 24-hour range to get your projected high or low, you're going to use the absolute high and absolute low to figure that out. So what I mean by that is you're going to take 84.75 and subtract 35.25 to figure out what the projected low might be if you're using the 24-hour session one. If you're using RTH, then you'll use only the RTH high or low to project. So that's the way you can use it. The next question is, should we look at the tick and advanced decline on a 2-minute or 5-minute chart? It really doesn't matter, I think. 2-minute works well for the advanced decline and tick. If I had to use one, I would recommend that one. Or you could even have it on both if you have enough real estate on the screen. The next question is, would you say the tick holding below 0 and printing minus 6 to 800 for an hour in the first hour has more weight than if the same thing happens during lunchtime? I don't know about having more weight, but I think that if it happens in the first hour, there is a better opportunity available to you. Because if it's happening in the first hour where the tick is completely below 0, then it's very likely that the range is going to expand to the downside. And because it's happening in the first hour, the range of the day hasn't really established yet, right? That means that you have a bigger target potential or bigger reward potential when that situation happens in the first hour. Whereas if it's happening over the lunch hour or a little bit later, it might still be a very good opportunity, but that's where you have to look at, okay, how much of the range potential has already played out and how much more is left. So that's the main difference between observing this in the first hour or observing it later in the day or in the afternoon, is that the range potential is going to be much greater during the first hour, and the expansion you can get from that range is going to be much greater. The next question here is, how do I get this chart set up for myself? So this is TradeStation. If you use TradeStation, it's fairly simple to set this up. I mean, you can see there's not really too much here. It's just the S&P price. And then in the second pane, we have advanced decline, and then we have the tick. And all you have to do is just do insert symbol, insert the symbols for AD and tick, and then plot those here. If you want the zones, they are plotted via an indicator. but it's not, again, one of those technical indicators. It's simply an indicator of convenience. It simply allows you to download the zones file, and then it prints or draws the zones right onto the chart. But it's not a requirement. You can technically look at the zones on the daily key levels chart or the trader worksheet and draw in the zones manually if you wanted to. This just saves a lot of time. So if you're using TradeStation or NinjaTrader or Sierra Chart, the indicator is available for those platforms, and you can go to the website and purchase it. But it's not a requirement. It's purely for convenience, but I think it provides great convenience because I don't have to then plot these on multiple time frames. I can have the zones on my 5 minute, 1 minute. It's very easy to get that set up, and I don't have to draw them manually on every single chart. So it makes it easy. Visually, it's nice to see, oh, it's going into resistance, or it's going into support. So it's definitely beneficial as a discretionary trader. But if you're using a platform that doesn't support the indicator, or I should say if the indicator is not available for your platform, then you can always just manually draw them in, and that can work just as well. The next question is, when you say fade a market when the price gets exhausted into a zone, can you give some rules of thumb on what it means for price to be exhausted? So the idea of exhaustion is that the market has moved too far, too quickly, without really resting or balancing in between. Now, what is considered exhaustion is going to vary from one market environment to the next. And that's why you have to really understand the volatility situation, right? You have to understand what kind of ranges we're getting these kind of days. But really the idea is that it's moved too quickly in a linear fashion without really resting or balancing in between. And it's not a small move of only, let's say 10 or 20% of the range, but that it covers a bigger part of the range. Now, this is not a mathematical thing, but if you had to make it a bit more mechanical, I would say it's a straight line move that covers around 40% to 50% of the range potential without really balancing or resting in between. But again, I don't look at it mechanically. To me, it's more visual. Where did the swing start? Where did it end? And did it kind of go up there in a linear fashion without resting or balancing or consolidating in between? Okay, I'll consider that to be overdone. Like for example, over here, you can see the market goes from 67.5. For the most part, there's about 10 minutes of balancing, but that's not really a big deal. For the most part, it goes straight line into the initial resistance zone. So it goes from 67.5 all the way up into 83. Well, that's a notable move. It's a 16-point move for the most part in a straight line. So is it more likely it's just going to keep on going and never look back, or is it more likely that sellers will be active here? Similarly over here, where does this move start? Starts at what, 74, 75, right? And then goes straight line down. There's a bit of balancing here, so you can consider this to be the first kind of swing. That's okay too. But you can see that it goes straight line down. So it is more visual for me. I'm not thinking of it mechanically, but if you had to, then I would say around 40 to 50% of the range potential for the day, and in a linear fashion without really pausing in between, and wide range bars, that kind of stuff. The next question is, how do you feel about fading tick extremes? So what this means is that, how do you feel about going against a tick extreme? So the rule for fading momentum or a tick extreme is that you must obtain good trade location. So anytime you're going against sustained momentum or a nice value on the tick, just make sure that you're being patient for the market to hit a zone and that you're getting good trade location. So like I mentioned earlier, there are mainly two types of trades, either momentum trades or location-based trades. So if you're going against momentum, you have to have location in your favor. And when you have location, you can go against momentum and vice versa, right? So when you have momentum in your favor and the market is set up for, let's say, a breakout or something, you're not going to have good location, right? On a breakout trade, you're not technically going to have good trade location. But that's okay because momentum's really in your favor. So that is the rule that you can use. But in terms of fading tick extremes, as long as the overall environment is still balanced and the market's heading into a notable zone, it's perfectly fine to fade tick extremes. The next question is, in the same way that initial support and initial resistance are higher probability compared to pre-market support resistance, do you find that the zones above or below the initial support resistance are also generally higher probability? That is not always the case. So for example, if the market is breaking outside of a larger time frame balance area, right? So if we look at, for example, this day over here, right, where the market was breaking outside of this entire balance. Well, on that day, remember that the environment is not conducive to zone fades. So on that day, we had bullish time frame alignment, right? That was the day where the short term was bullish and the intermediate term was bullish. So on that day, we're not looking to fade zones anyway. So in that instance, the zone after initial resistance is not going to carry much weight. But if the overall environment is still balanced, if on the larger time frame we're still stuck in a range, then the zones beyond initial support and resistance stand on their own, and they can still work. Now, whether they're higher or lower probability, there's not really any rule of thumb to that. It kind of depends on how much confluence there is at a zone. That's where you would want to figure out, what the range potential of the day is. It's the high of day in, low of day in. Those types of things can help figure out whether it's still worthwhile to fade those zones. Are we in a trending environment? Has a trend day kicked off? As long as those are answered correctly, I think you can still fade the zones beyond initial support resistance, but there's not a rule of thumb that they must be higher probability. It really depends on the situation. A question here is, on the trader worksheet, I see sometimes a zone from the previous day is not included in today's list of zones. So do we ignore those previous zones, or are they left to use on the current day? If a zone no longer exists on the current day, then there's a reason for it, and it should not be used. So the zones are updated every morning, and it's best to use the current zones, not the ones that were provided the day before, because every day the zones are changing and adjusting based on the market environment. A question here is, on the day time frame, does the market context leave the balanced bias and turn into a bullish or bearish bias once the market breaks and holds above the initial resistance or below the initial support? So that can certainly be the case, but if that's the case, I will usually talk about it in the morning video. For example, in this morning's video, I talked about how if the market breaks out above initial resistance and the overnight high, that the buyers would be regaining control. So on the upside, that was the case today. If we took this area out, the control would then be on the buy side, and the day time frame bias would become bullish. On the downside, it wasn't quite as straightforward. On the downside, the idea was that if we take out the initial support zone, we can still get buyers active at the zones below, and unless we're seeing a lot of weakness and trend down type conditions, we can just bounce right back up and still be balancing from there. So I think the morning video usually addresses this question. Okay, we might be neutral now, but at what point do we flip to bullish or bearish? And typically the morning video will explain that. So in today's case, on the upside, that would be the case. On the downside, not so much. The next question is a bull-bear zone more relevant for trend days to determine direction and irrelevant during range days? I don't think it's irrelevant on range-bound days, because the bull-bear zone is typically based on a slightly larger time frame pattern. So it can still be relevant even if the day is very range-bound. I don't think it's purely for trend days, no. The next question is, do you recommend and support swing trades on ES or just day trades? So the work that I do is based on the day time frame. The analysis that I provide is purely for day trading, and that's why the zones change on a day-by-day basis. Now, that being said, I think if you follow along and watch the morning video and watch the recap, you can figure out where a swing trade might make sense. Because I'll talk about how the market might be approaching a major or larger time frame support or resistance area where there could be a turning point. That's the case that we saw when the market recently hit 2718, right? On this particular day, going into this particular day, even though the market had recently broken out, it was now coming into larger time frame resistance. So you can use that as a cue to perhaps consider putting on a swing trade. But my focus is on day trading, and the analysis I provide is focused on day trading. So I don't want to kind of confuse people by mixing those two time frames, right? Day trading and swing trading. I think if I were ever to get into swing trading, I would create a totally separate kind of section on the website, or make it very clear that this analysis applies to swing trading and this applies to day trading. But at the moment, all my work is for day trading. Now, you can extrapolate and you can use some of those insights for swing trades, but I'm not going to specifically talk about swing trades, right? You're going to kind of have to read between the lines. And when I mention, larger time frame areas, larger time frame support resistance or major support resistance, that would be the cue that, hey, this could be a turning point on a larger time frame. If there's a larger time frame breakout or breakdown setting up, that could also be a cue for a swing trade that could last anywhere between 1 to 5 days. So, it's not something I specifically provide, but I think that anyone who is following along, watching the morning and evening videos, will usually have a very good idea of how the larger time frame is set up as well. The next question is, do you consider the VWAP at all in trade placement, such as look for longs above and shorts below? So the VWAP is really only relevant to me on directional days. So on balancing or two-sided days, the market will usually trade through the VWAP on both sides. So a general rule of only looking for longs above and shorts below doesn't really work. For example, the best trade for today, in my opinion, is shorting initial resistance. Well, that's when the market was above the VWAP, right? So first you have to start with the market environment. And that's why I said that understanding the market environment is paramount. And if you're in a directional environment or you're in a directional day, that's where the VWAP can be used as an entry point. So, for example, we can see that recently when we had that big upside day, every time the market came down to the VWAP, buyers stepped in, and that worked really well. But that only works when the market is directional. You can see here when the directional bias shifted and the sellers started becoming more active, the VWAP helped out and kind of showed us that the sellers were indeed much more dominant now. But if you're dealing with a two-sided day, the VWAP doesn't really play into it. It's not really going to support that rule of, buys above and sells below. So on two-sided sessions, the VWAP is better used as a target, if anything, rather than an entry point. The next question here is, once you have executed a properly calibrated stop target entry trade idea, how closely do you monitor it? How often do you exit at something other than the stop or target? So the target is most beneficial in determining your initial reward to risk and helping you figure out the entry. Once you're in the trade, then you need to see how that trade is developing. Now, like I said earlier, balancing at a zone before the market puts in that directional move you're looking for is very normal. But you should be watching on how the market is developing after you get in the trade. Because once you're in the trade, the market is continuing to provide you with more information. So as an example, let's say that we're fading the zone, but then we notice that the market barely pulls back and the tick just starts holding completely above zero, right? So let's say instead of the tick turning back down, what if it started holding completely above zero, printing nice values, and it just barely pulled back and it's just hanging around here? Well, that tells me that there is sustained upside momentum now. So maybe it made sense to short the market when I did, but maybe it no longer makes sense to be in that short. So in that situation, I'll get out of the trade. But that's not the majority. That's the minority of trades. So I think, it does make sense to assess it, but really don't micromanage it. Don't look for the slightest reason to get out of the trade. Something notable has to happen. Something important has to have shifted, has changed for you to say, okay, now I don't want to be in this trade. Now, in terms of the exit, it's not always going to be the same as the target. It might be better, it might be worse. It doesn't matter. The initial target is really beneficial in figuring out your reward to risk, but after you're in the trade, you should not just blindly hold to your target. You should be reading the market in real time. And as that trade progresses, it should start to look better and better. There are certain trades that you take them, and 15 minutes later, you're very grateful that you're in that trade from a great price, and you want to continue holding it. And there are other trades where you take them, and 5-10 minutes later, you're wondering, why'd you even take that trade to begin with? And there needs to be a stark difference between the two. They can't be very subtle and minor differences, because then there's something wrong. You're not reading it correctly. There should be big differences between those. The next question, aside from pre-market support resistance, are all the other zones equal weighted, or do some have greater importance than others? I don't think they're equal weighted. I do think some have more importance than others. And again, the trade plan video will usually highlight the ones that are more significant. A question here is, there's a comment about stop loss, 2 to 3 ticks. Is it real to have such a small stop loss, or is it a mistake? I think you misheard me. The stop loss is not 2 or 3 ticks. The idea was that your stop loss should be 1 point beyond the zone. So typically, even the minimum stop that we'll use is about 2 points. So on average, the stop that we use is around 3 points, and at the minimum, it's usually 2 points. So that's 8 ticks, and depending on volatility, it might even go as high as 5 or 6 points. But no, we don't use 2 or 3 tick stops. I think that would be too tight of a stop. The next question is, can I trade any zone or only wait for initial support and initial resistance? You can trade technically any zone. Be careful at the pre-market support and pre-market resistance, and be willing to be a little more aggressive at the initial support and initial resistance, and anything beyond that is okay too. Pre-market support resistance is really the main one that you want to be very cautious with. The next question, which is a request I get very often, is to provide levels for NQ, the Russell, YM. Honestly, I just don't have time for it. In the morning, there's a limited amount of time to put all this stuff together, publish it in time to get it out there 30 minutes before the open, get the video done, upload it, everything. And I think if I started adding more markets, at least based on my current schedule, it would degrade the quality of some of the stuff I do, and I'd rather not do that. So instead of adding more markets, even though I'm sure if I did that, more people would be interested, but I'd rather just provide the best service I can to the traders that are on the site trading the E-mini S&P, and then maybe in the future at some point, if things change and I can figure out a way to accommodate additional markets and still maintain the same quality, then maybe I'll think about it. The next question is, are your levels manually derived or are they programmed? So the zones are drawn by hand, or they're derived, I should say, by hand. They are manually derived. They are not programmatically derived. So there's not some technical program running in the background figuring all this stuff out for me, and I'm simply posting it for you guys. This is, every day looking at the market context, identifying the areas that are going to be the most relevant, that are going to have the highest odds of providing a response, making sure they're not going to get people in trouble, looking at it from many different angles, and then developing the zones. So it is manual. The question here is, do you hedge any of your trades with buying options? Like when you're short ES, have a short-term call option? No, I never hedge any of my trades. There's not really any benefit to doing it on the day time frame, for me at least. I think if I was trading on a larger time frame across a larger time horizon, I might look into that stuff. But as a day trader, it's better to keep it a little bit simpler in terms of execution and just be willing to take the loss. And I think the problem is that you have to look at a loss as a cost of doing business. You have to look at it as a operating expense, not something that's literally costing you. It would be like having a grocery store, and then every time you buy inventory, you think, oh my God, I lost money, right? That's not a loss. That's an operating expense. It's going to happen, right? It's part of the deal. So I think if you change the way you look at it, then you'll handle it differently. One question here is, what happens if you take an extended vacation? Well, the good thing is that even when I am on vacation, I'm still providing the zones and the trade plan. I know how valuable it is to people. I know that traders are using it every single day. I think in the last 10 years, it's been over 10 years now, in the last 10 years, I think there have been a handful of days, probably less than a handful of days, where the plan and the zones have not been posted. One time I was sick, I think, and I didn't get up in the morning. And I must have gotten like 50 emails from traders making sure I was alive, which was probably a good call because typically it's posted pretty much on time. The next question is, would you consider sharing your trades in real time? So basically providing, a trade signal service where every time I take a trade, I post, what trade I'm in. Personally, I'm not looking to do that. Sharing trades in real time. There's already enough going on in real time. And I would much rather teach how to trade rather than literally, serve trades as a signal service on a silver platter where you simply follow it and there's no skill development involved. There's no trader development going on. You're just kind of just blindly following every trade I take. I don't think that's really my focus. I like to help traders develop their own skill, and I'm simply helping you in that journey, and I'm helping you prepare before the market opens. I think a lot of the heavy lifting is in the pre-market analysis and in determining the zones. I think that's a big piece of it. But after that, the traders who make it are the ones who are committed and they're willing to put in the time and effort. And I think a trade signal service just kind of goes very much against that. And it becomes like a full-time job, and now you have to think about, okay, well, if I put this trade on, is it going to be managed correctly by everyone else? And it's kind of becomes a psychological issue too, I think, So the next question is, do you trade the first hour or the entire session? Definitely trade the first hour, not the entire session necessarily. I think the first 3 to 4 hours provide the best opportunities. So that's really where my focus is. And then quite often, I will not bother with the afternoon. I've tried doing it both ways. When I first got into it, I would trade whenever I could, the entire session and then even part of the overnight session. But then over time, you kind of find out where your strengths are and you find out where the best opportunities are. So in my experience, that's typically in the first half of the day. And the last hour calls for being more cautious. And Friday afternoons, I never trade. Friday afternoons are typically very low opportunity. So I haven't traded a Friday afternoon in probably 8-9 years now. So John, if you want to validate or invalidate your real-time analysis, watch the recap video. The recap video is essentially what I saw in real time. I know it comes out after the close, but it's not based on just looking at what happened and then figuring out whatever could have been done. It is based on a very defined methodology. And that's why on many days you'll see that there'll be a response at a zone, but I'm not going to talk about that being a trade idea. Just because it responded there doesn't mean it was set up correctly to take the trade. So the ideas I'm discussing in the recap are not theoretical. These are things I noted in real time. And that's why you can use it as a tool for skill development and to validate your own trades. The next question here is, can we use your zones in the overnight session or do they expire as soon as the market closes? No, you can still use them in the overnight session, especially the ones that have not been tested yet. Those tend to work the best in the overnight session. The ones that don't work are the ones where the market has gone around them, up and down both ways, and essentially invalidated that zone. Those don't work in the overnight session. But any zones that have not been tested, those are still typically valid in the overnight. There's a question here saying how to use the trade room. There is no trade room, so there is no live trading room on the website. I've personally never hosted a live trading room, and I think that majority of the rooms end up being more noise than signal, right? The signal to noise ratio, I think, is very poor in most of them. All right, guys, we've gone over 2 hours. Pretty exhausted here at this point in time. So at this point, we will wrap it up. Thank you for attending. I hope the webinar was helpful to you, and I hope that it helps you improve your trading. Just remember that trading is a game of skill. It requires constant skill development. You should always be focusing on getting better than you were yesterday. And as long as you have that commitment to skill development, improving your understanding of the market, then eventually, from my experience, from what I've seen from my own students, anyone can become a consistently profitable trader. You know, it's not a matter of having a particular background, having a degree, having, you know, some mathematical abilities or something like that. I mean, I've seen students succeed in trading from all walks of life, from all kinds of backgrounds, various age groups. You know, I think the oldest trader I personally mentored was close to 80 years old, and he did great. You know, he actually performed really well. The youngest one was like 21, and everything in between, guys, girls, whatever. Like, there's no commonality. You know, that was one of the questions I got when I was setting up this trader meetup a while back, and everyone wanted to know, like, is there some common string across successful traders? And I haven't seen it. You know, we've seen success from so many different people that at this point, I think anyone who is committed to it, you know, has a growth mindset and has persistence can make it work. It's just a matter of time. So we'll wrap it up with that. All right, guys, thank you for attending. Thanks for your time. Again, I hope it was helpful. Enjoy the rest of your evening, and you can hear me again tomorrow morning in the trade plan video. All right, good night.